Remember 2008? At least back then, the toxic mortgages were sliced up and sold to investors worldwide. This time, they are sitting on the balance sheets of your local banks. And there is $1.5 trillion of them maturing right now. Let me tell you what that means. Nearly $1 trillion in commercial real estate loans come due in 2025 alone. Another $500 billion in 2026. That's the maturity wall everyone's been whispering about. And it's not some abstract financial concept. It's actual buildings with actual tenants, or more often without them, and actual banks that lend actual money expecting to get paid back. Except now, when these loans come up for renewal, the numbers don't work anymore.
Here's a mechanism.
Most of these loans were originated between 2015 and 2020, when central banks were practically giving money away. Property owners borrowed at 3, maybe 4%. Their buildings were full. Their cash flow covered the debt service with room to spare. But loans don't last forever. Commercial mortgages typically run 5 to 10 years, and time's up. Now they need to refinance. Except the interest rate on new loans isn't 3% anymore. It's 7%, maybe higher. Do the arithmetic. A $50 million loan at 3% costs you $1.5 million a year in interest. At 7%, $3.5 million. That's an extra $2 million in annual debt service. Where's that money supposed to come from? Your tenants? Half of them work from home now. Your building's income hasn't doubled, it's fallen. And this isn't happening to a handful of over-leveraged speculators. This is systemic. Regional banks, the institutions that fund local businesses, hold deposits for your town's payroll, finance the strip malls and apartment complexes in your city. These banks hold 55% of all non-residential commercial mortgages in America. 49% of multifamily mortgages. That's a 20 percentage point increase since 2012. For a decade, while the mega banks on Wall Street scaled back their commercial real estate exposure after the financial crisis, regional banks gorged themselves on it. They chased yield. They chased growth. They built loan portfolios where commercial real estate is 38% of everything they've lent on average for the smaller institutions. Compare that to 12.5% for the giants. Now ask yourself, what happens when the buildings securing those loans are worth 30, 40, 50% less than they were 3 years ago? Because that's what's happening. Office vacancy rates hit nearly 20% nationally. In San Francisco, it's closer to 29%. And this isn't a blip. This isn't a recession we're waiting to end. Hybrid work is the new normal. 2/3 of workers are hybrid now, averaging fewer than 3 days a week in the office. Companies have figured out they don't need 10 floors when 5 will do. They're consolidating. They're downsizing. They're moving into newer, nicer Class A buildings with better amenities and breaking leases on the older ones. The older buildings, your Class B and C office towers, the ones built in the 80s and 90s, they are stranded. You can't just convert an office tower into housing. The floor plates are wrong. The plumbing's wrong. The windows don't open. The economics don't work. So these buildings sit, hemorrhaging cash, trying to cover debt service with half the rent they used to collect. And their valuations? They've collapsed. Commercial property values fell more than 6% year over year through the middle of last year. Office properties, specifically, are down 34% from their 2021 peak. When distressed properties get reappraised now, when a lender finally admits the loan's in trouble and brings in an honest appraiser, the numbers are showing 43% declines on average. For offices, 53%. Think about what that means for refinancing. You borrowed 50 million against the building worth 70 million. Seemed conservative. Now the building's worth 40 million and you owe 50. You're underwater. The bank's not giving you a new loan. They want you to put in 10 million of fresh equity just to break even. Do you have 10 million? Does anyone? Now multiply that story by thousands of buildings, tens of thousands. And remember where the loans sit. Over 22 banks with assets between $10 and $100 billion are holding commercial property loans that exceed 3 times their capital. 3 times their capital. That means if even a third of those loans go bad, the bank's insolvent. And we're not talking about 1 or 2 banks. Regulators identified 24 institutions requiring greater scrutiny for excessive commercial real estate concentrations. 47 smaller banks are in similar positions. Here's what's different from 2008. Back then, the mortgages were packaged up, sliced into tranches, sold to pension funds in Norway and insurance companies in Japan. The toxicity was dispersed. The losses were global. This time, regional banks originated these loans to hold them. The risk didn't get sold off. It's sitting right there on their balance sheets. And when these loans default, not if, when, the losses hit the bank's capital directly. Now, there is a wrinkle. Some of this debt was securitized. Commercial mortgage-backed securities, CMBS. And those are blowing up spectacularly. Office CMBS delinquency rates hit 11.8% in October. That's worse than the peak of the financial crisis. Worse. Multifamily CMBS delinquencies jumped to over 7%. The first time they've crossed that threshold in nearly a decade. So bondholders, pension funds, insurers, mutual funds that bought these supposedly safe securities, they are taking losses too. But the bulk of the exposure, 70% of the debt maturing through 2025, according to Morgan Stanley, is with regional banks. And it's on their books. So what are they doing? They're pretending. It's got a name in the industry. Extend and pretend. When a loan matures and the borrower can't refinance, the bank doesn't foreclose, can't foreclose. Because if they seize the building and mark it to market, they have to recognize the loss. That hits capital. That might trigger regulatory intervention, might cost executives their jobs, might wipe out shareholders. So instead, they extend the maturity. They modify the terms. They pretend the loan's still performing. They pretend the building's still worth what it used to be. And regulators, they're encouraging this. They're telling banks to work with borrowers, to show forbearance, to avoid fire sales that would crater the market further. But you can't pretend forever. Every loan they extend is a zombie. It's capital that should be written off but isn't. It's money that should be recycled into new productive loans but can't be. And it's setting up a bigger crash down the line, because the longer you pretend, the more bad loans pile up, the harder it becomes to distinguish the truly viable projects from the walking dead. And here's the cruel joke. The Federal Reserve has cut interest rates 5 times since late last year. They are trying to help. The benchmark rates down to 3.5%, 3.75%. But long-term treasury yields, the ones that actually determine mortgage rates, are still sitting around 4.1%. The yield curve uninverted, sure, but long rates didn't follow short rates down. So refinancing costs haven't actually fallen much. The Fed's throwing liquidity at a solvency problem. It's not working. Meanwhile, there is roughly $300 billion in what the industry calls dry powder, private equity, distressed debt funds, vulture capital. They're sitting on the sidelines, waiting for the forced sales, waiting for banks to finally give up on extend and pretend and dump properties at 50 cents on the dollar. But here's the stalemate. Sellers won't accept 40 or 50% haircuts. Not yet. They are still hoping for a miracle, a rate cut that changes everything, a return to office mandate that fills their buildings. Buyers won't pay 2021 prices. They know the fundamentals. They've done the math. So transaction volume is frozen. The bid-ask spread is enormous. Capital sits idle while distress deepens. Now, if you listen to the optimists, they'll tell you this is all manageable. They'll point out that Class A office buildings in prime locations are holding their value, even seeing rent growth. They'll remind you that the megabanks have minimal commercial real estate exposure. They'll say regional banks have diversified portfolios, that regulators are on top of it after Silicon Valley Bank, that losses will be absorbed over time. They'll call this a tale of two markets, where the good buildings are fine and the bad ones were always going to fail. And there's a kernel of truth in that. The best buildings in the best locations are doing okay. But that's not where the loans are. The bulk of the stock is older. It's in secondary markets. It's Class B and C. And even if megabanks are safe, we are not talking about megabanks. We are talking about 70% of $2 trillion sitting with regional banks. We are talking about dozens of institutions with concentration ratios that would make a risk manager resign on the spot. We are talking about banks that are too politically connected to let fail, but too numerous to bail out easily. Because here's the political economy problem. In 2008, you had a handful of too big to fail institutions: Citigroup, Bank of America, AIG. You could gather them in a room, you could orchestrate a rescue, however painful. But what do you do with 20, 30, 40 regional banks scattered across the country, each one medium-sized, each one locally important, each one bleeding from the same wound? You can't let them all fail. The deposit insurance fund isn't big enough. The political backlash would be lethal. But you can't bail them out overtly either. Not after the post-2008 reforms. Not after the rhetoric about ending too big to fail. So you'll get something quieter, something less visible. Regulatory forbearance that never gets called forbearance. Liquidity facilities that are really solvency patches. Accounting games. And eventually, when the games run out, taxpayer-funded recapitalizations disguised as something else. And who profits? Not the property owners, they'll lose equity. Not the regional banks, they'll eat losses, even if they get rescued. Not the bondholders in CMBS, they'll take haircuts. The ones who profit are the ones with the dry powder, the distressed debt funds, the private equity shops, the same ones who've been waiting patiently for 2 years. They'll buy buildings at 50 cents on the dollar. They'll hold them through the downturn. They'll wait for the next cycle. And when demand eventually returns, when the next generation of workers needs office space in a decade, those buildings will be worth par again, maybe more. Privatize the gains, socialize the losses. The oldest story in capitalism. Here's what this really is. It's not a liquidity crisis. Central banks can't print their way out of it. It's a solvency crisis. It's the bill for a decade of over-leveraging, of regulatory arbitrage, of chasing yield while pretending the music would never stop. It's the bill for pretending hybrid work was temporary. It's the bill for letting regional banks triple down on commercial real estate while regulators looked the other way. And it's a bill that comes due in installments: 2025, 2026, 2027. Each wave of maturities will reveal more losses. Each extend and pretend maneuver will eventually expire. Each distressed asset sale will reset comparable valuations lower, making the next round harder. Watch for the signs. Deposit outflows from exposed regional banks. FDIC intervention dressed up as mergers. Quietly announced capital raises at institutions that swore they were fine. And watch for the rhetoric. When they start saying this was unpredictable, that no one could have seen it coming, that hybrid work was impossible to forecast, that's when you'll know the rescues are beginning. Because here's the question I'll leave you with. $1.5 trillion in debt. Hundreds of banks overexposed. A maturity wall that doesn't care about political cycles or regulatory forbearance. When the bill finally comes due, and it will we demand that banks hold less commercial real estate and more capital? That regulators actually regulate? That the people who made these loans pay the price? Or will we just pretend this was all unforeseeable, bail them out quietly, and set up the next crisis? The maturity wall is here. The pretending is almost over. Someone's paying. The only question left is who?